Welcome to This Is Money podcast. I'm Georgie Frost, and joining me and Simon Lambert today is Tanya Jeffries. And coming up, Jeremy Hunt's high-risk plan to boost your pension. Some sceptical, others say it's not ambitious enough. It might be an idea to sort out our state pension first, though. Up to 10 million records may be wrong due to a 6-year computer failure cover-up exposed by This Is Money. Also today, the Bank of England reveals the pain of their hikes. Thousands a year extra will go on mortgage repayments for 1 million people. Simon says the bank owes them an apology. Meanwhile, the mortgage charter kicks in to help struggling homeowners. And would Britain's roads be safer if only women drove? Don't forget you stay up to date with all the latest breaking money news. Just go to thisismoney.co.uk or download the app.
Don't forget, you can stay on top of what's going on in the markets by tuning in to the Digest and Invest podcast by eToro. Go to your regular podcast platform and listen on the go. Digest and Invest by eToro, the podcast for those interested in trading and investing.
But first, under normal circumstances, we'd be rather sceptical of some bloke offering to boost your investments by 12%, but that is exactly what Jeremy Hunt is saying he could probably do for our pensions. The Chancellor has unveiled his plan to invest retirement savings to the benefit of you and hiking UK growth, so everyone's a winner. So what does it actually mean for us, though? And will it work? Welcome, Tanya. Welcome, Simon. Simon, give us the overview, and Tanya will get to the nitty-gritty. But politically speaking, what's the Chancellor doing here?
The Chancellor was making his Mansion House speech to the great and the good of the financial world. And as part of this, he unveiled measures that had been trailed for some time. We expected these. Tanya, in fact, wrote about them last week or the week before. And they're aimed at unlocking billions of pounds of pension cash to try and support the UK economy. What this involves is the largest defined contribution pension providers. These are the people who provide people's workplace pensions effectively nowadays, saying that they will allocate 5% of the assets in their default funds to unlisted equities by 2030. Unlisted equities, what's that? These are companies that are not listed on the stock exchange. Why would they be doing that? Well, there's been a bit of a shift in the corporate world over the last sort of 10 to 15 years, and companies are coming to market a lot later. So they're not coming onto the stock market until they've done a lot more growth than they would previously have done. The poster child for this sort of thing is the US, where you've seen companies grow to really quite substantial sizes and, grow their valuations quite, substantially, to use the word substantial twice, but I can't think of another word, before they end up on the stock market. So a lot of the value has been created before ordinary investors can get in. The investment tends to come from venture capital, private equity, wealthy individuals. Some funds invest in this kind of stuff. In fact, one of Britain's most popular investment funds, Scottish Mortgage, which specialises in investing in disruptive companies, the companies that it thinks are going to change the world over the next 10 years, has a sizable chunk of that investment trust invested in unlisted companies. Some other bloke invested in unlisted companies as well, and he didn't do quite as well.
I was about to say,
yeah,
are we talking about Neil Woodford here? Because I'm reading the book at the moment, and I was like, this is sounding really familiar.
Right. So Neil Woodford's pet project was sort of university spin-out biotech kind of companies, and that morphed into him investing quite a lot of his flagship UK equity income fund into unlisted companies that he thought could make a real difference and could bring this sort of disruptive growth. And he wanted to give his investors access to this. The problem with Neil Woodford is that when he was doing this in his patient capital investment trust, which literally said what you needed to be on the tin before you invested, patient and provide capital in a patient way, that was okay. And also because if you suddenly need to sell out of these assets, they can be quite difficult to sell. And with an investment trust, you're protected from being a forced seller or a forced buyer because of the way it's structured. It's listed on the stock exchange, so the shares can just fall to a discount to the net asset value. If it's an investment fund, you have to give people their money back when they ask for it, and you have to sell your investments to do that. So an investment fund is not a good place to be investing in unlisted companies. And it's worth noting Scottish Mortgage is an investment trust. Okay. So like Scottish Mortgage, the structure is right. Woodford came unstuck. And where Woodford really came unstuck was not just that he was doing this, but a lot of his investors thought they were investing in something very different to what they were actually investing in. So what Jeremy Hunt is proposing is not that we all say, hey, maybe we got that Woodford guy wrong and we should do exactly what he was doing. But what he's saying is that there is an opportunity there to back exciting UK companies and also try to stop us losing them from the point where they do all that growth and then they decide to list on the stock market and they list in the US rather than the UK, or they get bought out before they ever get to the stock market. He wants us to be backing the kind of companies that go on to become unicorns. That's an unlisted company that has achieved a $1 billion valuation. So these big pension funds are saying they're going to put 5% of the assets in their default funds into these equities. And Jeremy Hunt says it's going to add 12% to your pension. It's going to be worth £1,000 a year, apparently, in your retirement, basically. Now, I mean, that's quite a bold claim. It does have the ability to turbocharge your investments. It also has the ability to be a drag on your investments if the market turns against these unlisted companies. And they're not exactly the flavor of the month at the moment, although they are being buoyed by the whole AI drive. And that's what some of this is trying to capture as well, that kind of AI tech future kind of thing. Of course, as an investor, you do have a choice. You could just not put your money in the default fund and then it goes somewhere else. But there's a huge wall of capital here. And Jeremy Hunt's argument is that ultimately this pension fund money is long-term investment money. The default funds is people paying into their pension in their 20s, their 30s, their 40s. They're not going to access that money for 20 years. It's the kind of money that you can take a risk with. I'm sure Tanya will go into the problems with it, though.
Well, Tanya, I mean, on the face of it, we have an issue with people saving enough for retirement. So 12% boost seems very specific, but I mean, be that as it may. And investing in British companies. I mean, this is great, isn't it?
I think we need to back up a bit and talk about why the Chancellor is actually doing this. It's no secret that they want to get some growth going in the UK economy, and they've got very limited options and very little money available to try and stimulate the economy in any way. There's £2.5 trillion invested in UK pension funds, and a lot of it is invested abroad because the people running pension funds invest it in the best way they see fit to get the best return. And that is how things have played out. Whenever there's a great big pot of cash sitting somewhere, the government does like to eye it up. And I think that's what it's done in this case. You also have to bear in mind that it's really hard for the government to borrow at the moment. Forget the disastrous mini budget. The cost of borrowing is just up because interest rates are up, and it is very difficult for them to borrow a lot at the moment. So the idea is that this might be an easy way of co-opting the nation's savings in this patriotic endeavour to boost UK GDP, basically. And if you look at the kind of things that they're doing, the pensions industry is split up between lots of different types of pensions. And Simon mentioned one, which are the defined contribution funds, the modern ones that most people are in now. But there's also the old final salary pension schemes. There's public sector schemes, some of which are funded by the taxpayer, so they're not involved in this. But some do invest, and they might be important. And so the Chancellor, in the Mansion House speech, he announced a whole list of things which apply differently depending on what kind of pension fund you've got. Now, Simon mentioned this compact. It is a voluntary compact among the defined contribution pensions. They're the ones that will you put your money in and it's invested to build your pot that you then have at retirement to generate an income from. So, and you bear all the investment risk. So you're exposed in that case. But the default funds that most people stay with because they don't want to invest on their own, those big pension funds, we're talking about the big insurers, really, the likes of L&G and Aegon and so on. They still want to make sure their default fund is invested for the best possible growth, whether that may be and however they want to do it. So they have very politely and obligingly said that it will be their goal to put 5% in unlisted equities by 2030. Well, we've got an election turn of next year, end of next year, beginning of the year after. So this is a polite, voluntary offer to the current Chancellor. So we'll see where that goes. The other stuff, for the other kinds of pensions, is actually trickier. They've only announced a consultation with the final salary schemes, because those are the ones where, they're closed to new entrants. So they're winding down. They've got to stay safe so that they're guaranteed pensions. So they've got to be invested in safe things until the last person in the last one dies, and they don't have to pay anybody anymore. So as you can imagine, it's going to take quite a shift to get those kind of funds investing in riskier assets. Where they might have some leeway is the local government pension fund, because they can basically ask them to take a look at riskier investment. So that is definitely a possibility. And then one big wheeze that they've got is the pension protection fund. That's a lifeboat fund for the kind of final salary pensions, the guaranteed pensions that I was just talking about. It sits there and takes the pension funds on when their employers go bust, if their employers go bust. And there's talk of it's very successful. It is sitting on a massive surplus. And so the idea is that a new super fund would be created where the old final salary pensions or more will be put into that, and the pension protection fund would be in charge of investing, and they could do it more adventurously. They'd have scale and so on. So as you can see, it does all get a bit involved and technical. And the more you look into it, the more you think, yes, but could they do this? Could they really do that? And at the end of the day, the crucial thing is it's individual people's money that they're putting aside for retirement. And the companies that mind it for us have really got a duty. If they're in charge of it, we've delegated the job to them of looking after our money. Their job is to invest it in the best way possible. So it's really difficult to see how this will have a huge impact beyond. It will have some impact, maybe on the margins. And I can't see how it's going to be like a huge trigger for massive economic growth, even supposing a lot of the things that they're talking about are taking off. One thing I will say, though, is that Labour seems to be in favour of the same thing in terms of co-opting pension funds. And when it comes to making it mandatory, obviously, so far we've been talking about a voluntary thing for the defined contribution schemes. Rachel Reeves has rather ominously said, well, we won't have to make them because they'll be persuaded to do it anyway. Well, that really sounds like, well, you better be persuaded or else we'll start looking at ways to make you invest in the UK growth prospectus. So that's where things stand. It's a really interesting idea, and but it's got a lot of pitfalls. And I would say that the industry has been polite and helpful in some ways, but there have definitely been some dissenting voices.
Well, that's the thing on your website. You have asked the other experts, including yourself, but you've asked the experts, what have they been telling you about their view?
There's a big range, and some people think the Chancellor's not been bold enough, and actually they'd like him to do a lot more. And by the sound of it, they wouldn't mind it being mandatory. Oh, just go harder and faster, make them do it, put more in, make it even riskier, basically, more risk for more reward, right, in the great cause of boosting the economy. I think those people and the ones who run these kinds of riskier funds are the ones most pro going bigger. But as I say, there's been quite a lot of polite, yes, we'll go along with you, and yes, we'll voluntarily do what you say. So there's quite a lot of people in the industry who are making noises like that in the middle. But some people have taken the Chancellor a bit to task about this 12% figure. Just to be clear about this, it could boost your pension pot by 12%. They're looking at it like an 18-year-old investing for their entire life as an average earner, and what they might come out with at the end. And then the 1,000 a year is what income you might, how that might improve your income on an average basis over the years of your retirement. So obviously it's very generalized. The trouble is you're not supposed to make claims like that. It's scammers who make claims like that. Oh, I can get you a 12% guaranteed investment return. And people have pointed out in no uncertain terms that if they, in the finance industry, made a claim like we could get you a 12% return, no problem, they would be in a certain amount of trouble. The FCA would probably be taking a look at them. There's also some skepticism about the cost of this as well, especially investing in private equity. There's really high performance fees on that kind of thing. And if you actually drill down into the detail, which some of them have, it really, once they've taken their massive cut, then you're only talking about a much smaller bump in what your potential return might be for investing in much riskier assets. So that's the state of play, and we'll see what happens. It's definitely an interesting one to watch, and I think that watching what Labour says about it is also of great interest, because we can all read the polls. It's very unclear what might happen over the coming year, but if Labour does get in, whether they want to stick with this or go any further is definitely going to be of great interest to people who want their savings to be invested for them in their interests, not necessarily in the government's.
Simon, is there an issue with, putting the growth to one side, our own pensions, that defaults are just too safe?
Well, there is, a problem with default funds and people not really engaging with them and just opting for the default. And one of the problems with default funds is actually this old-fashioned idea called lifestyling, whereby as you got closer to your retirement age, you would be de-risked, and so you would start scaling down from shares to bonds to maybe some cash and other, any other assets considered to be safe. And many people, or in fact most people, keep their pension invested in retirement now if they've got a defined contribution pension. So they don't necessarily want to be de-risking in the same way that they did in the old days, when what happened was you hit that retirement date and you took your pot of money and you took some of it as your tax-free lump sum and you put the rest of it into an annuity. So there's a problem with default funds there. There's a problem with default funds in that, depending on which pension provider you're with, the default fund might be slightly different. The best default fund you can have is a very, very cheap global stock market tracker fund as a kind of shares fund, and then a very, very cheap fund that invests in investment grade government debt in your own currency. So for a UK investor, gilts, right? That's the simplest way of doing the investment balancing act. You invest all around the world, you let companies and their success and the stock market and everything just look after all that stock market growth. You just believe that companies' ability to make profits over the long term wins through, and the winners rise up and the losers fall down, and you just go for that long-term investing thing, which lots and lots of studies, as we talked about in the podcast last week, have shown are the best way of delivering inflation-beating returns. And then, dependent on your risk, you balance it out with some bonds. Now, there's arguments about whether the whole equities to bonds, balancing out still works, but that's just the simplest way of doing it. Not all default funds are just very, very simple global stock market trackers. Some of them might be more in the UK, for example. Some of them might be more expensive than a really simple global stock market tracker. Some of them might do something different. So there is a problem with default funds there. There's a problem with people engaging with their pensions, but most people don't want to engage with this stuff. If you're listening to this podcast, you are in the percentage of people most likely to want to engage with this stuff. You've passed the test already. The vast majority of people have got no interest in engaging with this. They pay their money in and they hope it's invested in the right place, which does create an opportunity for the government to go, we'll have some of that money, we'll invest it in UK growth companies. Really, if you're taking 5% of people's pensions and you're investing it in smaller growth companies, you probably shouldn't just be investing it in smaller UK growth companies. You should be investing it in smaller growth companies, unlisted companies around the world, because you're taking a big bet with 5% on UK unlisted companies, which are a really small part of the market. Okay. So there is this shaky ground here, but there's a way you could do this yourself as well, depending on your pension provider and how much freedom they give you to invest in investment, different trusts and funds and things. If you've got total freedom, if you've got a SIPP, for example, you could just go buy Scottish Mortgage, and that will invest in disruptive companies, and part of that will be unlisted companies picked by, some fund managers who've had a tough time as the environment has flipped from low rates to high rates, but are among the best fund managers in the business, at one of the best respected fund houses, with one of the best teams behind them. And I tell you what, they'll charge you a lot less than a private equity house will do for having some of your money in unlisted companies, because Scottish Mortgage charges 0.34% as an ongoing charge per year. And the great news is, even though it's a growth trust, it pays a dividend as well. And it pays a dividend of, I'm just checking here on my screen, 0.62%. So the dividend yield more than covers the charges. As I said, performance has been troublesome recently, but long term it's got a very good record. But you see, you could do this disruptive thing yourself for a lot less than the 2 and 20 that some private equity manager might be taking off you in fees. And the one thing I would say is, I don't necessarily think this is a bad idea. And I think more of our pensions should be going towards trying to, go towards growth in this country, back this country. More of it should be invested in the UK stock market, but that you are then skewing your investments. You do have to realise that. But I do think that the one part of the financial industry that this is absolutely great for is the sort of private equity, venture capital bit, where all of this pension money is going to flow in there, and they're going to take whacking great big fees off the back of it.
Yes, indeed. One thing that the next story makes me think is it would be good if the government sorted out the mess with the state pension before they started talking about anything else related to pensions, because Tanya, sadly every time I get you on, we're talking about another sort of cock up or cover up or mess up or computer failure. And this time it looks like up to 10 million people who claimed universal credit could have shortfalls in their state pension due to a secret computer failure exposed by your good selves. Now, this includes up to 137,000 people already drawing a state pension, although the exact total is unknown, as no one has been informed by the Department for Work and Pensions if there is any kind of error. Tanya, not another one.
Yes, another one. We've talked about this on the podcast before. It specifically involves people who are on universal credit, who get credits, national insurance credits towards their state pension. We started talking about a mystery glitch based on reader information last autumn. And then the readers, who were absolutely amazing in giving us lots of evidence, gave us emails and documents that they'd been supplied by the DWP itself, which showed that the system for updating these credits broke in 2017. Nothing obvious was being done about it, except when you were 4 months away from state pension age, they'd sort it out for you. Well, people falling through the net, because we discovered some people who'd fallen through the net and it had not been updated 4 months before retirement age. So they retired on the wrong amount. And there's also a big issue with people who have the wrong state pension forecast and then go off and spend loads of money on state pension top-ups, which is another area of complete chaos and meltdown within the DWP, but that's a separate story. But if you've bought these top-ups wrongly, then you need to go and get a refund, which is another problem down the line. Apparently people will get refunds. So we exposed this and really discovered what had really been going on and published a story about it in February. Coincidentally, I'm sure it was February when they actually fixed the problem. It had been going on for 6 years. I do not know why the very month that we brought this whole problem to light, which they had not told anybody about, suddenly amazingly got fixed the same month. I'll leave people to draw their own conclusions on that one. But they have fixed it. So HMRC are now in the process of updating everybody's credits. And after that, state pension forecasts will have to be recalculated. The HMRC phase is going to take until, I think, May next year, definitely spring next year. So a lot of people are sitting on wrong forecasts. A lot of people have bought top-ups and don't know whether they should have done or not. Some people want to buy top-ups but aren't sure whether it's worth it. I think some people have got so desperate because their state pension records haven't been updated that they've bought top-ups knowing that they don't need to, but they want to try and start off on the right foot with their state pension when they start drawing it. So there's a lot of confusion. And yet again, we've got a vast number of people who have got wrong forecast. And in the case of 130 up to 137,000 people, some people will have got a full record anyway on their own behalf, or will have got credits elsewhere, which make it up. But that's still an awful lot of people who may already be retired and are not being paid what they should be paid.
Any advice for us, Tanya?
Well, it's very difficult because the people who have tried to get it sorted out have spent an extraordinary amount of time on the phone ringing the DWP, HMRC. Actually, two separate departments of the DWP are involved in this. The people who, look after state pension records and the universal credit people, and none have been helpful. Now it's all a big exercise is underway to fix it. I suspect that they will keep turning people away, saying, we're fixing this, we're in the process of fixing this, and you're just going to have to wait. And so people are still going to be stuck. Where you have got a bit of leeway is if you're within 4 months of state pension age, or you've already retired and you think you've been affected by this, then you can possibly make a bit more of a fuss about it. You can also contact us. We're obviously still looking into cases like this, and it's pensionquestions@thisismoney.co.uk.
Right, that's it for part one.
Don't forget, you can stay on top of what's going on in the markets by tuning in to the Digest and Invest podcast by eToro. Go to your regular podcast platform and listen on the go. Digest and Invest by eToro, the podcast for those interested in trading and investing.
Welcome back. The Bank of England revealed this week just how much extra homeowners will be paying on their mortgages as a result of their successive rate hikes. And, well, it's not pretty. Despite the economy so far proving resilient, it says, uncertainty persists with the full impact of hikes yet to materialise. Simon, well, it's just what you've been saying, isn't it? How bad is it?
It depends if you've got a mortgage or not that's up for renewal. If you've got a mortgage that's up for renewal, it's pretty bad. And the Bank of England decided to lay that bare for everyone this week, while saying the economy was proving resilient, ... so far. So basically, if you've got a mortgage, then at some point over the next 2 years, you are going to see your repayments rise, depending on when your mortgage is up for renewal, stating the bleeding obvious. People are getting absolutely hammered at the moment on this. The average 2-year fixed rate this week managed the dubious distinction of rising above the Liz Truss, Kwasi Kwarteng mini-budget chaos levels. We were at 6.75% yesterday and rising. And basically everybody's prepping for it to hit 7% next week. I mean, that is immense. And we're caught in this sort of vicious circle of interest rate expectations. Everybody expects the Bank of England is going to keep going. Gilt yields going up, swap rates going up. Banks are pulling mortgages because to be honest, they want to throttle demand. They don't want to get caught out by offering them cheaper than they can fund them, but they also just don't want too much business at the moment. And it has created the perfect storm. A number of times over the past 6 weeks, I've said the words, well, I think we're probably at peak panic now. And then peak panic just keeps going. The rates keep going up. The problem is that if you can sit on the sidelines, it is not so bad. If you need to renew your mortgage now or in the next few months, you've got a major headache. But as the Bank of England helpfully pointed out, you're going to have a headache if you need to remortgage it any time in the next 2 years. So to put things in context, about 1 million people, by the Bank of England's forecast, face their mortgage going up by £500 a month or more. So that's at least £10,000 out of your salary if you're a higher rate taxpayer. That's what that works out as. £500 a month, £6,000 a year, £10,000 a year of pre-tax earnings. That is a serious hit to people's living standards. Can you imagine if the Chancellor said, I'm going to tax everybody on more than 50 grand, an extra 10 grand a year? There'd be uproar. But, I mean, this is effectively what's happening to people's wages. The breakdown of those poor people includes 500,000 people who are going to be paying an extra £500 to £749 a month more, about 250,000 people who are going to be paying £1,000 a month more, and slightly less than that, probably about 200,000 who are going to be paying £750 to £999. Now, the chart also shows that there's about another 600,000 people who are going to pay at least £300 to £400 more, another 500,000 people who are going to pay £400 £500 more, another million people who are going to pay £200 to £300 a month more. This is a lot of money being sucked out of the economy and out of people's pockets. And it's also something that the Bank of England highlighted is hitting in a more disproportionate nature than it would have done in the past. This is due to the fact that the lever that the Bank of England has to pull to try and crack down on inflation is raising the base rate, monetary policy. That's what's driving up mortgage rates, and it's hitting a smaller number of people in order to make the impact that it needs to, because there are less mortgaged homeowners in this country than there used to be. There are more homeowners, generally older, who own their property without a mortgage, and there's also a sizable number of renters. But many of them are also seeing their payments go up because they have mortgaged buy-to-let landlords who are being hammered even harder than homeowners at the moment. So it's basically a bad situation, is what the Bank of England painted for people, and then tried to put this sort of slight gloss on it, which didn't fool anyone.
No, indeed. And you have written an article?
Yes. Well, I mean, look, this won't be news to anybody who listens to this podcast regularly. I think the Bank of England owes people an apology. The Bank of England spent years going around pledging that rate rises, when it came, they would be gradual and limited. Put the words rate rise, gradual and limited into a search engine and see what it brings up. You'll find lots of speeches from Bank of England members. You'll find Mark Carney there. You'll even find a Bank of England paper. I think it's actually a publication of someone's speech, but it comes from the Bank of England website. They haven't been gradual and limited. They've been brutal and sudden. And the words were being put out for a reason. It was to try to reassure a generation of homeowners, borrowers who had no choice, if they wanted to own a property, than to mega mortgage up and pay the massively inflated house prices, because there wasn't another option. There wasn't a parallel universe where you said, I'll tell you what, actually, I don't want your mortgage at 2% and your 500 grand property. I'll take your mortgage at 5% and I'll take your 300 grand property. That world didn't exist. They didn't get offered that one. Many of them would have chosen it. Okay. The maths work out better. So it was that, or it was rent. And the people who could buy and wanted to buy, they bought. And the Bank of England went around telling them, don't worry about this stuff. Okay. It's fine. When rates go up, it'll go up gently. It'll be fine. Okay. It'll be fine. You don't need to worry about it. And there were lots of people who did worry about this stuff. There were commentators, there were economists, there were people in the media like us who sort of said, it's just a bit mad, this whole house prices versus wages, super low mortgage rates, this is going to end in tears kind of scenario. But you have to play the game. Hey, I bought a house in it. I've got a massive mortgage on a super low rate. I'm going to get absolutely shafted like most of my generation when my mortgage is up for renewal. But what the alternative was, don't buy a house. So, everybody was reassured about this. And then the exact opposite happened. Now, obviously, the Bank of England has to crack down on inflation, and the Bank of England only has monetary policy to deal with this. But the Bank of England absolutely compounded this issue. Firstly, the Bank of England and the government did nothing to try to rein in house prices when mortgage rates were so artificially low with those post-financial crisis lows. There was some tinkering around the edges with the affordability rules and stuff like that. But actually, the affordability rules enabled banks and building societies to lend people more money, not less. It enabled them to justify how much money they were lending them based on the fact that their monthly payments were low. But of course, when rates went up, their monthly payments went through the roof. You would have been better off with the old system that our parents' generation had in the 80s, where they'd only lend you a certain multiple of your salary. If we'd have stuck with multiple of salary lending, we'd never have had the same problem that we have now, because house prices would have had a cap on them. They would not have been able to get so high above wages. And there were some little caps brought in, like only a certain percentage of the mortgage book could be more than X times, people's salary and the stress test and stuff like that. But everybody knew that wasn't really making any difference. Come on, they're not stupid. You don't have to look too hard at the numbers to work out that wasn't doing anything to keep a lid on house prices. Government bunged in the stamp duty holiday, which again was madness, right? If you want to do something about stamp duty, you do it permanently. Any form of tax holiday only causes more of a problem, because you pull forward all these people trying to buy something, and then lots of people go out, lots of demand trying to buy something where there's a limited supply of. At the same time, the Bank of England totally failed to act on inflation. Now, it's very easy to blame Russia invading Ukraine. It's very easy to blame, global problems. It's very easy to blame the awkward recovery from the lockdowns. But the signs were there. We've talked about this loads of times on the podcast. I'm not going to go over it again and again and again. The signs were there in summer 2020 that interest rates did not need to be at 0.1%. Couldn't get a hot tub. Couldn't get a UK holiday let. Couldn't get expensive garden furniture. Couldn't get loads of expensive household items. That was not the signs of an economy that needed interest rates at 0.1%. Not at the same time as the Bank of England was printing money, and the government was literally handing money straight to people in the form of furlough and giving loads of money to businesses and just chucking money around. And then Rishi Sunak helpfully illustrated that interest rates didn't need to be so low by creating Eat Out to Help Out, a month in which everybody went bananas for getting a discount on their lunch and their dinner, indicating economy not as bad as you think. Maybe we just try to get rates up. Now, I was talking to someone about this the other day, and they said they should have just put interest rates up to 3% in early 2021. I was like, it's maybe a bit mad. That would have caused absolute chaos. You think it's bad now? Imagine if they'd suddenly put interest rates from 0.1% to 3% in early 2021. But you get the sentiment behind it. They should have moved much faster. It should have just gone, right, okay, we're going back to 0.5%, and then we're going to 1%. They should have laid out and said, this is what we're going to do. And that would have helped Britain get ahead of inflation in a way that it hasn't done. And we wouldn't have the problem where our inflation is much worse than other people's. There are other things that come into that. Brexit does come into that. I'm sorry to say, that it does come into that. There are pros of Brexit and there are cons of Brexit. And one of the cons of Brexit is it is causing us more inflation. But we had the opportunity to do something about it, and we totally fluffed it. And it was the Bank of England that fluffed it, and it was the government that fluffed it. But unfortunately, it's a generation of homeowners who are paying the price for it. As I said, hopefully we're at peak panic. I think a couple of sets of good inflation figures, interest rate expectations could turn around. They won't go as high as people think. Banks and building societies will settle down. They'll start offering mortgages again. Mortgage rates will start to come down. We'll see an easing of the panic, just like we did after the trust panic. The problem is that even if that happens for a large chunk of a generation of homeowners, the damage has already been done.
But we have a new mortgage charter.
Yes, this is something that Jeremy Hunt has organised with the biggest lenders. He had them all in for a chat. And some of the things that they've been doing already, and some of the things they signed up to do. But the idea is that you make things a lot easier for people who are on the sharp end of these really big hikes in their mortgage payments. So if you want to extend your mortgage term or move to interest only for 6 months, this won't affect your credit rating. They've also got something about you can talk to your lender and they won't judge you. Well, that's a bit more airy-fairy. One thing that is important is repossessions. From the first missed payment, you've got 12 months grace period really to get things sorted out before they'll start trying to repossess your home, which is obviously a big deal. I mean, the amount of money that Simon was talking about that you suddenly have to find extra to pay your mortgage is a massive worry. But behind all that is a really, really fundamental thing, which is, where am I going to live? At the end of all this is, am I going to have a place to live in, and where, and the rest of my family, where are we going to end up? And that is one of the reasons why people get so terrified about all this. And when Simon says, it's really damaged a whole generation, even if they're the ones who managed to remortgage when things got a little bit better between the trust disaster and then this current crisis, or even if they remortgage on the other side of that, they will really have been scared. They will have been really, really worried by this. And you can't underestimate the impact that has. It will have all sorts of shockwaves down the line, not just political, but in terms of how people view their personal finances and what they're prepared to risk and what they're not prepared to risk. But anyway, that's a short summary of what the lenders have signed up to, just to try and ease the way a little bit for people facing these big payment shocks. It doesn't sound like a panacea to me, but it will help some people. You do have to be aware, though, especially if you're thinking of extending or going interest only, that you are going to end up paying more money as a result of doing that. It will bring you some breathing space, but it's definitely worth having a good look at the numbers to see if it's absolutely necessary before you do that. And you'll have to factor in the fact that you're going to have to pay more for longer or find a lot of extra money if you're going interest only for a while on the other side of it before your mortgage term ends.
Thank you very much, Tanya. Now for something a little bit different. I wonder if Lee Boyce would approve as an and finally story. But for too long, women have been the butt of driving jokes. Do the statistics bear out? In the battle of the sexes, who really is the better driver? Now, you've been analysing motoring conviction data and road casualty stats, Simon. Well, Rob Hull has. What did he find?
There's a general rule with newspaper headlines. If it asks a question, the answer is no. This headline asks the question, would Britain's roads be safer if only women drove? All of the rules, all of the best rules can be broken. And the answer to this one is, yeah, it would seem to be the case. So CarWow did a deep dive into official road traffic statistics. Now, actually, before we talk about this, one thing that is worth mentioning is that I don't think that we hear this enough. You hear a lot of stuff saying, oh, we need to do this, we need to do that, we need to do that in terms of road safety, around speed limits, driving, that kind of thing. There's this campaign, this constant campaign to bring drink driving limits down to like Scottish levels, which are very, very low. Now, like most drink driving casualties are caused by people who they're drunk, right? They're way over the limit. There isn't any evidence between the one there. But one of the things they say is we haven't brought down road deaths. We haven't brought them down. They're not falling. They've plateaued. It's the same when we talk about speed limits and things like this. What is often not mentioned in this is actually there's a real positive in terms of British road safety. It is literally among the best in the world. In fact, when it was last measured against Europe in 2018, the UK recorded 28 fatalities per million inhabitants. That's the lowest of every single EU country, and the average is 49, right? And Britain's road casualty record has remained relatively unchanged since. But we have obviously left the EU. But this is really good. Statistically speaking, Britain's road safety credentials are excellent, right? Okay. But they would be a lot better, it would seem, if we didn't allow men on the road. So CarWow did a deep dive, and it took the figures, and then it worked out what would happen if you took men out of it, but then you doubled female drivers' mileage to account for the fact that there weren't the men doing the driving. But then also you added an extra bit to cover the fact that men on average cover 7% more miles than women. So we got the same amount of mileage being done here. This isn't just if you took half the drivers off the road, would the roads be safer? Yes, obviously. And if you were selective about how you did it, the roads would be really good. So women are responsible for just 18% of all motoring offences. So if only women drove, doing the maths here, there would be a 62.4% reduction in overall motoring offences. Ministry of Justice figures show that Ministry of Justice figures show that 658,711 people in Britain were convicted of motoring offences last year, but only 18% of them were women. So multiply the female convictions by 207%, takes the woman-only total to 247,508, which is 62.4% less than the overall total. Men are far more likely to be convicted of drink, drug, and dangerous driving. If only women drove, it worked out there'd be a 59% reduction in drink driving, an 80.9% reduction in drug driving, a 91.2% reduction in dangerous driving, and a 79.9% reduction in death by dangerous and careless driving. I mean, I suppose there's lots of men out there who would say, yeah, maybe only women should be allowed to drive home from the pub. They wouldn't complain about that. They're like, it would be a lift home. But those are the stats there. Far less speeding and use of mobile phones behind the wheel. If only women drove, 51% less speeding, 71.4% reduction in mobile phone offences. Seems like men are the chief offenders on that. And unfortunately, in-car fatalities are much higher for men than women as well. If only women drove, it calculated a 67.9% reduction in car occupant death. And that's not one to make any jokes about, so I won't. But anyway, it does appear to show that statistically speaking, women are the much safer drivers, and in many cases that would be taken to equal much better drivers.
You're throwing it out there, Simon. I mean, the world would probably be a bit of a safer place if just men stayed at home. Maybe that might be sensible. What is it, like 90% of all serious crime is done by men, about 80% of homicides, 95% of domestic abuse. I mean, not saying anything, Tanya, but maybe just keep them at home.
Yeah, the trouble is this kind of thing isn't anything really beyond a good headline. Men are going to drive. Men have to drive. All the driving that men do, in terms of like the buses, the haulage industry, and so on, they still do most of that. So we've got to live in the real world. Obviously, people are going to drive it. The figures on who holds licenses are pretty much split down the middle. I think it's 51% men and 49% women. Usually the answer to this kind of thing is more education, better testing, more testing, regular testing, a better regime to try and reduce these figures still further, because we might be better than Europe, but that's still too many deaths, isn't it? And you're never going to wipe them out completely, and you can't take people off the road for the kind of ridiculous, reason that they were born a man or a woman. Then, so I think, what you need to do is improve the testing and make sure everybody learns to drive more safely.
Saying we're better than Europe is not exactly the greatest of accolades, because, I'm in Florence at the moment. You take your life into your own hands. Simon, I do want
safest,
to know...
but not just in Europe, actually. Europe's roads are among the world's safest. Britain basically has...
Oh my God, there you go.
Britain, I'm not sure of the exact statistics, but Britain is there or thereabouts in having the safest roads in the world. Again, something not many people know, which is why I made the point at the start of this conversation, is that it is always worth making this point.
Yeah.
That actually there is something that we're really good at.
I do have to ask... I do have to ask, though, Simon, if we were to break this down by age, and not to sort of focus on the young men here, but the insurance companies do, if we took that out, would older men be safer than women or less risky than... Do they have the stats, or is that Carwell's next project?
No, those stats weren't in there. I mean, he doesn't pinpoint it down. It didn't go quite as into the detail where we could say from this point on only 28-year-old women are allowed on the road and nobody else. But there are hey, look, to take it back to the finance and investing angle, there are figures that show that if only women invested, they'd do better as well. The thing there though is, would they actually do better? Because if you took all the men out of the equation, then the women wouldn't be able to take advantage of the men's stupidity. Yeah. So it's a bit different to driving.
Yeah.
Well, maybe that's what they're doing on the roads as well.
Full context. We just look better in comparison. Right, that's it. We're going down a really deep rabbit hole now. So I'll rescue it back again. You can keep up to date with all the latest breaking news. Just go to thisismoney.co.uk or download the app. And if you have any comments or questions for the team or anything you'd like them to look into, Simon.
You can email us at editor@thisismoney.co.uk. You can tweet us at thisismoney. You can come to thisismoney.co.uk/podcast to find all podcasts past. And before we go, I should say something, which is that this week it was the Headline Money Awards, and they are the top awards for financial journalism. And a certain person on this podcast, Tanya Jeffries, won an Outstanding Achievement Award for her work in recent years being at the forefront of highlighting pensions injustice. I quote here, "This highly respected investment and pensions editor has persistently campaigned for those affected by flaws in the pension system, driving awareness of issues such as state pension underpayments, DWP calculation errors, government failures to notify women about state pension age hikes, and the little understood link between child benefit and the state pension. Demonstrating the power of investigative journalism and the importance of listening to readers' problems, alongside Sir Steve Webb, her work exposing state pension underpayments went on to trigger a National Audit Office investigation, resulting in a government report crediting her role in bringing the scandal to light." So, well done, Tanya. But also the fact that it's not about the awards, it's about all of the people that Tanya and Steve have helped with all of this work over the last few years, and they have put real money in real people's pockets and made a real difference to their retirement years. So bravo, Tanya, and bravo, Steve, as well.
Indeed. Bravo, Tanya. It sounds like we're retiring you, but we're not, are we? You're going to continue fighting readers' corners and all that sort of jazz. You're not going anywhere, are you, Tanya?
Absolutely. Steve and I have got many campaigns on the go. I won't reveal them at this stage. We're still working on them, but yes, we've got plenty. Unfortunately, there's plenty more pension injustice out there to be fought.
Well done, Tanya. Richly deserved, and thank you on behalf of the listeners and readers. And if you like our podcast, why not rate us wherever you found us? It helps other people find us too.
Don't forget, you can stay on top of what's going on in the markets by tuning in to the Digest and Invest podcast by eToro. Go to your regular podcast platform and listen on the go. Digest and Invest by eToro, the podcast for those interested in trading and investing.